Hi, Leeb Group viewers. Today's Monday, September 21st. We've been saying repeatedly in recent months that this market is highly unusual, and that's a story we're sticking to. The nature of this rally has been unlike anything we've encountered, with no discrimination taking place between industry groups. The only real distinguishing characteristics has been that junk stocks have been the top performers at the expense of high-quality shares. Small caps, as measured by the unweighted average of all stocks traded on the New York Stock Exchange, have risen in 24 of the last 28 weeks, gaining 133% in the process. The S&P 500, meanwhile, over the same time frame, is up 20 of the last 28 weeks, gaining 56% in the process, excluding dividends. Not too shabby, but don't hold your breath waiting for similar gains going forward, as valuations are already stretched as they get. Stocks have only been as overbought as they are today twice before, at least on record. First case, November 1932, the second in June through October of 33. In each of those prior cases, it proved to be the end of bear market rallies that saw share prices quickly give up much of their gains. 28% in the following 4 months in 1932, and there was a 21% decline in the following 5 months after the 33 peak. There were some other impressive rallies that followed, but keep in mind that we didn't get to a successful retest until 4.5 years later in 1938. Now, that said, we don't expect things to play out exactly the same way this time, but it should give you reason to pause. There's a growing chorus proclaiming the recession is dead and buried, and to be sure, the economy is growing here, but if the economy shows any weakness whatsoever, stocks are going to come tumbling down in a hurry. The mere fact that T-bill yields are at 9 basis points tells you that all is not well with the world. More recently, in Japan in the 1990s, equities enjoyed several powerful rallies that each in turn saw stocks give up the ghost. Today, nearly 20 years after their peak, the Nikkei is little more than a quarter of where it was at its high water mark. So if you're long this market, consider lightening up on your holdings, and if you're itching to buy, concentrate your investments on the commodity sector. They may not be immune to a decline if one occurs, as we expect, but they will be the big winners, hands down, in the years ahead. Thanks for stopping by.